After a midsummer global tech outage affecting millions, CrowdStrike stock went from 390 down to 201 in less than a month, losing 48%. My analysis at the time showed CrowdStrike as a buy, and the stock soared from 201, hitting 300 in the past few days for a 50% rebound. So, is this just the beginning, or is the rally about to fizzle out? Let's dive right in. 3 points that we are going to cover in this model. Number one, background/business model. Company was founded in 2011. It's a cybersecurity company for the cloud era. With its AI native Falcon XDR platform, CrowdStrike created the first true cloud-native platform with artificial intelligence at the core, capable of harnessing vast amounts of security data to deliver solutions through a single agent. Now, just a heads up, this video is an update to my previous one from 2 months ago, so feel free to check that out for more background info on the company. Part 2, company update and the opportunity, positives and negatives. So some of the world's largest enterprises, government organizations, and high-profile brands trust CrowdStrike to protect their business. As of July 31st, 2024, CrowdStrike had over 30,000 subscription customers worldwide. The aftermath of the global tech outage, 2Q results, and their recent Falcon investor event, we're going to cover it all. Part 3, the valuation. On Wall Street, we build 3-statement financial models culminating in a discounted cash flow or DCF valuation. I have built a 3-statement model with a DCF for CrowdStrike, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. All right, part 1, background/business model. Company background. The company was founded in 2011 by George Kurtz, Dmitry Alperovich, and Greg Marston. George Kurtz is the current CEO. The company is headquartered in Sunnyvale, California, which is in Silicon Valley, the hub for tech companies. The industry that they operate in is cybersecurity. It involves protecting computers, networks, and data from unauthorized access or attacks. The company mission: to stop breaches and protect customers from cyber threats. So CrowdStrike aims to provide the best possible security solutions to keep businesses and individuals safe online. Now, these are some crazy statistics here. CrowdStrike services more than 70% of the Fortune 100, 18 of the top 20 US banks, and 44 out of the 50 states in the United States of America. Incredible. Business model. So how do they make money? So the cloud-based platform known as Falcon operates in the cloud. It doesn't require customers to have special hardware or software installed on their computers. It provides real-time protection, continuously monitoring for suspicious activity, and stops potential threats before they can cause harm. And it's very easy to use. Being cloud-based makes it easier for customers to use and manage, as updates and improvements are handled by CrowdStrike seamlessly. Or in terms of where the revenues come from, so 94% of revenues are from subscription services. So CrowdStrike offers its cybersecurity solutions through a subscription model. So there's regular payments where customers pay a recurring fee, either monthly or annually, to access CrowdStrike services. And there's also the Falcon platform, which is a cloud-based security system that detects and prevents cyber threats in real time. 6% of revenues come from professional services. CrowdStrike also offers specialized services to help organizations when they are under attack or need extra protection. So for example, they have incident response, providing immediate assistance to companies experiencing a cyber attack, helping to mitigate damage and restore security. There's also threat hunting. So they have experts that are proactively searching for threats that might have bypassed regular defenses, ensuring higher levels of security. All right, part 2, company updates and the opportunity, positives and negatives. So key highlights from CrowdStrike's 2Q 2025 results. So record revenue of $964 million, which is up 32% year over year. So this reflects strong customer demand and growing reliance on CrowdStrike cybersecurity services, positioning it as a market leader. Annual recurring revenue, ARR, $3.86 billion, up 32% year over year. This ARR shows the stability of the subscription model, highlighting consistent customer retention and growing adoption of its services. Also, new ARR, so new annual recurring revenue of $218 million, up 11% year over year. This indicates new customer growth and upselling success, showing that more businesses trust CrowdStrike for security. Cloud, identity, and log scale ARR over $1 billion, up 85% year over year. This is phenomenal. These announcements reflect strong financial performance, customer growth, and a clear focus on innovation and global expansion. This rapid growth demonstrates the expansion of CrowdStrike into cloud and identity security, key areas of future growth for the company. Non-GAAP operating income, $227 million, up 46% year over year. This strong profitability shows effective cost management, indicating a healthy financial structure even during aggressive expansion. Module adoption. So 48% of their $100,000 plus annual recurring revenue customers adopted 8 plus modules. So high module adoption shows that customers are deeply integrating CrowdStrike's offerings, making it harder for competitors to break in and reduce churn risk. So ultimately, these are very sticky customers. So, what's the takeaway? Each number points to business resilience, innovation, and growing trust in CrowdStrike as cybersecurity becomes more crucial globally. This sets the stage for continued dominance and success in the market. Recently, the company had their Falcon investor event, which happens every year where they update investors on what's going on, the latest and greatest with the company. So, the Falcon 2024 roadmap, CEO George Kurtz shared the vision for expanding AI powered threat detection, positioning CrowdStrike to stay ahead of evolving cyber threats. He said, quote, "We're not just playing defense, we're pushing the boundaries of innovation." Obviously, the elephant in the room, the global tech outage, which is known as the Channel File 291 incident. So George Kurtz directly addressed the recent global tech outage. It was caused by the conflict between a Microsoft update and CrowdStrike's platform. So Kurtz directly addressed the Microsoft-related outage, explaining, quote, "We took immediate steps to ensure this doesn't happen again." He framed the incident as a learning opportunity and emphasized the swift recovery, earning customer praise. New product launches. So Falcon Fusion XDR gives clients deep insights into cloud threats. Adam Myers, the SVP of Intelligence, called it the most advanced threat detection we've ever built. A live demo showcased its ability to see everything in the threat landscape. Business developments and acquisitions. CrowdStrike announced the acquisition of Preempt Security, boosting identity protection capabilities. Also, they're strengthening their partnerships with Amazon Web Services, or AWS, and Microsoft Azure as security partners for cloud adoption. Future outlook, the company is aiming for $5 billion in annual revenue in the coming years, fueled by international expansion and continued subscription growth. The CFO emphasized their strong recurring revenue and their long-term runway. Resilience in action. So, a story of how Falcon stopped a major breach for a financial client in just 30 minutes, saving millions of dollars, was presented at the event. And Kurtz noted, "We're the difference between success and failure." AI and machine learning focus. So the cyber criminals are using AI. We have to be 2 steps ahead. That's what George Kurtz said, explaining and highlighting the increasing role of AI in keeping their platform 1 step ahead of attackers. So what's the conclusion? As George Kurtz said, we don't just prevent breaches, we stop them before they even happen. This is absolutely tremendous and very important for companies. You don't want to have a problem. You never want to have the problem occur. So what's the takeaway? CrowdStrike showcased innovation, addressed challenges, and set bold growth goals, confidently leading the future of cybersecurity. All right, the opportunity, positives, and negatives. I want to hit the bad news first, so let's start with the negatives. Valuation concerns. So some people believe the stock is overvalued, which could pose risks if growth slows or they don't meet expectations. Highly competitive market. So cybersecurity is very crowded. Strong players like Palo Alto Networks and obviously Microsoft posing threats. Recent outage, obviously we've talked about it, the Channel File 291 incident, the global tech outage, dented short-term customer trust, raising reliability concerns. And then lastly, dependence on subscriptions. So a heavy reliance on subscription revenue could hurt if their churn rates increase. All right, so what about the positives? Strong revenue growth. They have consistent year-over-year revenue increases, showcasing customer growth and industry leadership. They also have high ARR, or annual recurring revenue. So a robust subscription model provides stable, predictable cash flow, which is a huge plus for investors. Also, innovation in cloud and AI. So they're leading advancements in cloud security and AI-powered threat detection, keeping them ahead of competitors. Profitability. So they had record operating income, strong free cash flow, and great financial health. High module adoption. So deep customer integration shows strong retention and reduces churn risk. All right, part 3, the moment we've all been waiting for, the valuation. So we're going to start out with the balance sheet. Cash has increased over 38x over the last 5 years, going from 88 million to 3.4 billion, and it's projected to almost 4x from here to get to almost 13 billion in 2028. Remember, this is not only software as a service, it's also cloud-based, so there's no inventory. The company has done an incredible job managing its cost of revenue. We're going to see this next in the income statement. Now, strategic investments, I cover this extensively in my previous video. They have a Falcon Fund, which is the venture capital arm of CrowdStrike, and that is only going to continue to grow. Also, CrowdStrike has very little debt, $750 million at a 3% annual coupon that doesn't come due until 2029. On top of that, the company is net cash as year-end by 2.6 billion, as of current 3.3 billion. Lastly, retained earnings saw an inflection point in 2023 where it began to increase rather than decrease due to the company finally generating positive net income. So what's the takeaway? The company has a clean balance sheet, rapidly growing cash, and it can be deployed to make capital expenditures, acquisitions, and even contribute more capital to their internal VC fund. So they have plenty of great options available. Let's hop in the model. All right, y'all, balance sheet. Here's the highlights. Massive increase in cash over the last several years. Strategic investments. This is their venture capital fund known as Falcon. Really cool stuff going on there. Their debt, super manageable. There's no debt payments over the next 5 years. And then last but not least, retained earnings. Inflection point, we saw it going from going down to now coming back up. All right, next we have the income statement. So revenues have increased over 12x in the last 5 years, going from 250 million to over 3 billion. So this equates to a 5-year compound annual growth rate of 65% year over year. It's like face ripping. Gross profit has increased substantially, with gross margin expanding over 20% in the last 7 years. It's gone from 57% in 2017 to 77.3% in 2023. This shows the company is managing costs effectively as it grows rapidly. 2023 was a huge year for the company because they became EBITDA and net income positive for the first time. With over 3 billion in cash, the company generated almost 150 million of interest income from investing in marketable securities. We're going to see this next in the cash flow statement. So what's the takeaway? CrowdStrike is really beginning to hit its stride with positive EBITDA and net income for the first time in company history and high double-digit top-line growth. The company is really demonstrating tremendous results. Let's hop in the model. All right, income statement. As you can see, massive increase in revenue, 65% year over year in terms of the last 5 years, 12.2x over the last 5 years. Absolutely incredible. But not only are they increasing their revenues, they're also growing their gross profit pretty substantially, and they're showing that they're more efficient at managing their costs. EBITDA positive for the first time, net income positive for the first time. So little round of applause, a little clap there for CrowdStrike. And then interest income, don't discount this. They have 90.6 million of net income, and they have 148.9 million of interest income. So literally, if they didn't make this interest from their invested cash, they would be net income negative. That's how powerful their cash balance is. All right, next, the cash flow statement. After turning positive 4 years ago, free cash flow has increased over 50x in the last 4 years. Insane. So like many of the Mag 7 tech companies, CrowdStrike is investing its massive cash balance into marketable securities consisting of highly liquid investments such as U.S. Treasury securities, commercial paper, and repurchase agreements. Over the last 7 years, CrowdStrike has generated over 1.4 billion from these investments. There's no scheduled debt repayments over the next 5 years because the only debt the company has comes due in 2029. One final thing to note about equity issuance, the company IPO'd in 2019. So why do we see further equity issuance from 2020 to 2023? These are proceeds from the exercise of stock options as well as employee stock purchase plans. So what's the takeaway? CrowdStrike is a solid and consistent generator of free cash flow. It's projected to generate over 9.6 billion of cash over the next 5 years. And this massive cash stockpile will give it ability to not only reinvest in their growth, but also make transformational acquisitions. Let's hop in the model. All right, cash flow statement, massive increase in free cash flow. You can see that they have a rapid growth going on here. And not only that, but when you look at the capital expenditures relative to the growth in their operating cash flow, they don't have a lot of CapEx. So they're able to just continually make tons of cash flow without having to reinvest a ton in the company to generate it. Also, if we look down here, we see that they have marketable securities purchases that they're making. So basically, they're reinvesting their cash into marketable securities. That's 1.3 billion over the last 5 years. There's no debt repayments over the next 5 years because they have what's called a bullet payment on that debt. So there's no amortization of it. And then also, as I mentioned, equity issuance, although they IPO'd in 2019, so you see this big pop here, the question is, are they issuing more stock? Is that diluting shareholders? No, that is not the case. They're not issuing more shares. Basically, what they're doing is they're issuing shares to employees when they have stock options that come due. All right, forecast drivers and DCF assumptions. So the company projects 3.89 to 3.9 billion in 2024 revenues. And the issue is they have reduced their top line revenue growth estimates by 2.5%. This has caused a reduction of 95 million as compared to the previous model that we did 2 months ago. So ultimately, they have addressed the issue that they had with the global tech outage, and they're moving forward from it. We have accounted for that. That's why we ultimately updated the model. Also, the company has done an outstanding job managing its costs despite rapid growth. So case in point, operating expenditures were 99% of sales in 2019. Company guidance for this year is 48 to 60%. That's a total absolute reduction of 40 to 50%, which is absolutely mind-boggling. Now, for a high growth cybersecurity company, they have a very reasonable beta of only 1.1. That's less risky than the majority of the Mag 7. Also, we have a terminal multiple of 10x. Now, while that might seem high, it actually isn't relative to the comps, and it's about half their current TEV to revenue multiple of 19.2 times. So we're going to see all of this next in the DCF valuation. What is the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. All right, so one of the things I want to mention is the guidance has come down. So the previous revenue growth guidance that we used in the last model was 30.1 to 31.3%. So we actually stuck with 30%. This time we're going with 27.5%. So a reduction of 2.5%. Cost of equity, 7.93. Post-tax cost of debt, 4.57. We get a weighted average cost of capital of 7.9%, which is actually super low and very reasonable. You can see that they don't have much debt. It's only 1% debt as a percentage of total capital. Also, something to note, this is as of their most recent quarter. They have over $4 billion worth of cash, which is absolutely tremendous. And then lastly, want to cover the fact that they have a 10 times revenue multiple. People might think, oh my gosh, that's super high. But if you look at the comps right here, 9.4 times is the current average of their comps. And I excluded the high and low from those comps, and I still got 9.4. And the all-time low for the TEV to revenue multiple for CrowdStrike is 10.1x. So by using 10x, we're being super, super conservative. All right, DCF valuation, we ran 3 scenarios, bear, base, and bull, with the current model at base. Future cash flows are discounted back to today. To get to TEV, we strip out net debt to get to equity value. They're a leading player in the cybersecurity space with eye-popping growth. They're net cash by $3.3 billion, but after skyrocketing from the post-tech outage low of 201 to $300 a share a few days ago, is it worth buying today? Now, Wall Street has CrowdStrike at an average of $325 per share, which is a 12.6% discount. So what does our analysis show? Let's hop in the model. All right, y'all, DCF valuation time, EBITDA less DNA. We get EBIT, strip out the cash taxes. We get EV out or NOPAT, add back DNA, take into account changes in operating working capital, also CapEx. We get our free cash flow to the firm. Our terminal value, don't forget that's 10 times the terminal revenue in the terminal year of 2028. We get our cash flows to discount. We discount all of them. We get present values of free cash flows. That gives us our TEV, or total enterprise value. We strip out debt. We add cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value of $79.8 billion. And we divide that by the shares out, we get a value of $325.68, basically $326 a share. Current close, $288.54. That is a discount of about 13%, which is a solid hold rating. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth and CapEx intensity, as well as WACC versus the terminal multiple. Now, in our previous model, we showed the bulk were buy. Now we show the bulk are hold. So in the current model, 0 out of 50 or 0% showed a sell rating, 47 out of 50 or 94% showed a hold rating, 3 out of 50 or 6% showed a buy rating. In our previous model, we had a weighted average value of 333. In our current model, we ran each of the 3 scenarios equally weighted, got a weighted average value of 326, which is a 13% discount. So the company's still at a discount, but not as big of a discount as it was in the previous analysis. So what's the takeaway? Utilizing conservative assumptions, we show a solid hold rating for the stock across all 3 scenarios. Let's hop in the model. All right, sensitivity analysis, as we mentioned, 94% are hold. Looks like gold everywhere, but it's a solid hold, not gold. Also, if you look down here, same thing. So ultimately, we see the bulk are going to be a hold rating and a little bit on the buy side. Next, we come to the scenario analysis. Remember, we ran a downside bear case, a base case, and then an upside bull case. So we get a range of 313 to 339 for the stock. We show a hold rating across the board. 326 is the weighted average, about a 13% discount, a solid hold rating. All right, the wrap up. So Wall Street has CrowdStrike at a low of 185, which is a 64% premium, an average of 325, which is a 13% discount, and a high of 540, which is an 87% discount. Now, the stock is up 43.6% since the post-tech outage low of 201, and it's up 16.9% year to date due to the pullback. So my average price in the stock is $241.73. So based on the close of $288.54 in this model, I'm up 19.4% in only a couple of months. That's 116% annualized. Now, you should seek the advice of an investment professional always. I don't know your financial situation. This content is meant to educate. But it is important to note that I do have a position in CrowdStrike. I just mentioned it. I do plan on holding it based on the findings of this analysis. The fundamentals are very solid. They're a high-growth company with expanding margins, $3.3 billion of net cash, and they're a leader in the cybersecurity space. While the global tech outage was a major screw-up, the company's quick response, acceptance of full responsibility, and positive feedback from its customers provides a case study on how companies should respond to a crisis. Now, after the tech outage, I analyzed the company, determined the pullback in the stock was way overblown, and followed Warren Buffett's advice of buying when there's blood in the streets, and I'm happy that I did. The company has noted there will be an impact to revenue of $60 million, down in the back half of the year. So we actually modeled revenues going down 95% in the back half of the year, where that's 50% more. Again, it's even more conservative. Now, this is a classic hold scenario. It's still at a double digit discount. The fundamentals are rock solid, and growth is increasing with margin expansion. Now, while it's not as juicy of a discount as it was 2 months ago, as an owner of CrowdStrike, I don't plan on selling anytime soon. With a dominant position in an industry that is growing at a 10 to 14% CAGR, CrowdStrike is an incredible investment opportunity in the cybersecurity space. Now, if you like this and you want to see another stock valuation, you could check out my Rocket Lab model here or my NVIDIA model here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.